Not all financial advisors are made the same. The right financial advisor can add hundreds of thousands of dollars to your net worth. The wrong financial advisor could cost you hundreds of thousands of dollars, if not more. And unfortunately, most people don't know that there's different types of financial advisors, let alone how much your financial advisor is costing you. But that ends today with this video. Let's start with a very basic example. Let's assume that two people are investing $1,000 a month and they're investing their money into the same type of financial advisor. You'll see what I mean in just a moment. But they're getting two different types of returns. Financial advisor A is getting an average 11% return a year. Financial advisor B is getting an average 10.25% return a year, a little bit less. But the difference here also is that financial advisor A costs a little bit more to get those higher returns. They're charging 1.5% on your assets. Financial advisor B is charging 0.5% on your assets. What happens after 40 years of investing $1,000 a month? With financial advisor A, you're going to end up with $4.6 million, which is a lot of money. But with financial advisor B, you're going to end up with $4.9 million. That's an extra $300,000 in your pocket just because you understood the fees better. But that's really just the beginning. In general, you have four different types of financial advisors. You have fee-only financial advisors, you have commission-only financial advisors, you have fee-based financial advisors, and then you have performance-based financial advisors. They're all financial advisors, but they can cost you very different amounts of money. Now, I want to remind you that for those of you that are investors and you want to stay up to date on top of what's happening in the financial markets, my team at Briefs Media publishes a free daily report called Market Briefs, where we're breaking down what's happening in the economy, housing, stocks, crypto, and global markets into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that read Market Briefs every morning, and when you join Market Briefs as a complimentary bonus, you're also going to get an investing masterclass taught by me, where I'll walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. This is all completely free, so if you want to get Market Briefs plus get my investing masterclass, all you have to do is click the link down in the description below. The way fee-only financial advisors get paid is you have to send them some money. So that means they might be charging you a flat fee, maybe $2,000 a month, $2,000 a year. They might charge you a percentage of your assets under management. So if they charge you 1% of your total assets, that means if you invest $100,000, you're going to be paying $1,000 a year. And as you grow your assets, your financial advisor is going to make more money, because now if you have $1 million, 1% of $1 million is $10,000 a year. Then you have an hourly rate, which might be $200 an hour, just to consult with your financial advisor. Commission-only advisors make money when they sell you certain types of financial products. So they're going to be selling you mutual funds, they might be selling you life insurance, they might be selling you other financial services, and then they're going to take a percentage off of what they sell you. So they're kind of like salespeople. The more stuff they sell you, the bigger the stuff they sell you, the more money they make. Now, just like anything else, there's going to be some good commission-only advisors. There's going to be some, maybe a lot, of not so good commission-only advisors, because they get paid based off of more things that you buy. Fee-based advisors are more of a hybrid of the first two. These are people that might charge you a flat fee, maybe $1,000 a year, maybe $1,000 a month, maybe a percentage of your assets, plus getting a percentage of commissions. Now, generally the way it works is they're going to charge you a lower fee because they're also making these commissions, but the whole idea here is they're making some money off your assets plus a commission on the products that they sell you. A performance-based advisor is going to take a percentage of your growth, maybe a percentage of your profits, maybe a percentage of profits above a certain baseline, above a certain percentage. The risk and problem here is many of these performance-based advisors only work with high net worth clients because, well, unless you have a lot of money to invest, it doesn't excite some financial advisors to take this risk. So if you have a financial advisor or you're thinking about getting a financial advisor, the first question you want to ask is, how are you getting paid? Are you this, or this? And the second question that you want to ask is this advisor a fiduciary? Now, what a fiduciary means, this advisor has to, by law, do things with your best interest first. Now, that might seem pretty straightforward. I mean, every advisor is supposed to do that, but a fiduciary gives you the legal obligation that they're supposed to do whatever is right for you first. Now, generally, not all the time, but generally the way it works is that these fee-only advisors are going to be fiduciaries. These commission-only advisors don't have to be fiduciaries. These fee-based advisors are sometimes fiduciaries, sometimes they're not. And these performance-based advisors are generally going to be fiduciaries. You as somebody who is trusting somebody else with their money, want a fiduciary as your financial advisor, because if they're going to be managing your money, if they're going to be working to grow your money, you want them to have a legal obligation to work with your best interests in mind. Now, that doesn't always mean they're always going to follow the law, but you at least want that protection. This is where it can help to know what are your different types of investment options that you have, because you don't need a financial advisor, and some of you might benefit from a financial advisor. So let me break down what I call investment types out there. Now, we're not talking about traders, we're talking about investors where you're taking your money and you're putting it to work for the long term. Number one is you can be a passive investor. When I talk about being a passive investor, I'm talking about following a dollar cost average strategy. I call it ABB, always be buying. This is where you find a few indexes that you want to invest in. Maybe the S&P 500. That's a group of the 500 largest companies in the stock market. Maybe the total stock market. Maybe the Dow Jones. Now what you're doing is you follow a system where every week or every 2 weeks or every month, you are just investing into these funds and you set it and forget it. You don't need a financial advisor to do that. And what we've seen is that the S&P 500 has grown by between 10 to 11% a year on average for the last 100 years. So you can do that on your own. You open up a stock brokerage that helps you do this type of passive investing, and it's set it and forget it. The key is when things go down, when you go through a recession, when you go through a market crash, you don't touch it. You don't sell. The only thing that you do is potentially buy more. Option number two is being more of an active investor. An active investor is where now you are looking for opportunities where you can see bigger potential return. You're investing in individual stocks. You're finding those niche opportunities because you're seeing that the money is moving into a particular industry. You see money is moving into data centers. Money is moving into AI. Money is moving into this particular industry. And now you look for stocks that will benefit over the long term because of this shift. This takes more work, more time, more energy, more research, more money. But with that more risk also comes more potential return, because now you can find some of those bigger opportunities. But again, it takes more time and it's more risky. But for some of you, this might be a great opportunity. For others of you, you're going to say, I don't want to have to worry about anything. I don't want to be an active investor. I don't know what the S&P 500 is. I don't want to worry about any of that. I just want to give my money to a financial advisor, which is where a financial advisor can be helpful. Now, one piece of advice that I will give, although I'm just a random guy on YouTube, I can't give you advice because investing has risks. You're never guaranteed to make money or invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But the piece of knowledge that I will tell you is working with a financial advisor is kind of like working with a doctor. Unless you have some sort of basic knowledge, you can't help guide them. You want to have multiple opinions. You want to know that what the advisor is doing makes sense for you. That's why you want to understand how advisors work, how they charge you, and you want to know if their strategy aligns with yours. Maybe you want more cash flow, you want more dividends, you want more strategies that are going to give you more income, or maybe tax protection, or maybe you want more growth. If you have that goal, you want an advisor that can specialize and help you with that goal. If you don't know that basic knowledge, well, the advisor is going to do whatever they think is best, and what they think is best might not be best for you. Then you have option 4, which is a hybrid approach. Now, this hybrid approach can be really a combination of any of these. You could be a passive investor and an active investor. That's what I do. I have money that's automatically invested into my portfolio of funds every Wednesday. Why Wednesday? Because it's in the middle of the week. No secret sauce there. Every Wednesday, money is passively invested into my portfolio of funds. I also have separate money that I put aside for my active investments. Now, how do I find these active investments? Well, my firm at Briefs Pro, we have a team of analysts that are researching what we call market shifts, that are looking for those opportunities. We publish it in a weekly report. That's something that I'm interested in. But again, it's not for everybody. For some people, this hybrid model is going to be being some sort of investor plus an advisor, where now you may be investing some of your money yourself, but you also want an advisor for other estate planning, for maybe some tax strategies, for whatever types of strategies to help you invest your money. Again, personal finance is personal, because what's right for you is not going to be right for me, but a financial advisor can be helpful, again, when you have the basic knowledge of understanding, number one, how they can help serve your goals. Do you have a good type of financial advisor, and understanding how they're getting paid? Because the reason why a lot of people get upset with their financial advisor is they have no idea how the financial advisor is making money, and then they have no idea how the financial advisor is investing money, and then they see returns that are subpar, and then they see how much money their advisor is making, and then they get completely upset, which makes sense. But this is where I want you to understand the way financial advisors work. Some financial advisors are going to be great. Some of them are going to suck. Half of financial advisors graduated in the bottom of their class, so be willing to talk to multiple advisors that we could find one that works for you. Now this is where I want to tie the whole video together, because in the beginning of this video I gave an example of a financial advisor charging you 0.5% fees and somebody else charging you 1.5% in fees. And this is where sometimes you can be cheap and end up costing you more money. And what I mean by that is sometimes, yes, paying a percentage of your assets to a financial advisor can cost you more money. Other times, it can get you into the door of a much better financial advisor who can make you better investment decisions. Sometimes paying a flat fee or an hourly fee is going to be better for you, depending on your situation, if you have the knowledge to know what's right and you can invest your money yourself. For others of you who want to get access to certain financial advisors who only manage your money by taking a percentage of your assets under management, well, you got to understand what you're getting. And that's where not every financial advisor who charges you a big percentage is going to be worth it. Not every advisor that charges you a flat fee is going to be worth it. But this is where your knowledge, your basic financial education can be very helpful if you want to work with a financial advisor to ask them questions, see how good they are, see their past returns, and then you can have a little bit of hope that they make some good decisions for you, because past returns don't guarantee future returns. Investing is risky, and this is where, for those of you that want to work with a financial advisor, you have to have a lot of trust. Because if they don't do a good job, well, you have to be okay with the fact that you trusted this advisor with that decision, with your money. Now, for others of you that want to do it yourself, that's completely fine. You just got to understand the risks and be willing to put in the work and the research. That way you can do it yourself. Again, if you want some more resources, you can check out Market Briefs, my free financial newsletter. I have the link for you down in the description. President Trump signed the One Big Beautiful Bill Act into law. This big bill will bring some big changes to our economy, starting with some big tax breaks to big funding for certain things like more deportations. And the reason why you want to pay attention to this bill is because it goes into effect retroactively. It goes into effect January 1, 2025.